Hello, we are Strategist 1, and this is our People's Express Simulation Project. Our group members are myself, Tom, next is Casey, then Matt, Chris, and Tarek.
Hi, I'm Casey. I'll be talking about the base case and the Don Berg case. For the Haparetti, or base case, the strategy was to lease 3 aircrafts, fly them for a few years until they made enough money to buy a plane of their own. This means no additions to the fleet or staff, low prices, and moderately aggressive marketing. The low fares offset the poor quality enough to maintain a high load factor. In the base case, the only variable was the employees. At first, the new hires and employee turnover peaked after year 1 and then balanced out after year 2. Revenue passenger miles grew and pretty much flatlined just enough above the break-even point to stay profitable. Share price reached 16 and net income flatlined at about 13 million. For the Don Berg case, aircrafts were bought at an increasing rate until 75 aircrafts were purchased. A rate of 55 employees per aircraft was kept, as well as an aggressive marketing strategy of 15%. Price was kept low to match the low target service scope. In this case, assets grew rapidly, but so did their debt. Revenue and operating costs quickly rose together and never produced a steady net income. Cash flow was negative, and the stock crashed after year 3. Employee turnover skyrocketed and significantly decreased customer service. And now we're going to talk about the 3 strategic scenarios we came up with: slow and steady, high fares, high satisfaction, and lose to win.
Hi, my name is Matt, and I'll be talking about our first scenario, slow and steady. In this scenario, we focused on slow growth, lower fares, and keeping a constant 55 employees per aircraft. Our strategy for buying aircraft was to wait 1 year to build positive cash flows and start buying 1 plane at the beginning of every year after that. We set our fares at 13 cents and kept them flat for 5 years. We decided on keeping marketing at a mid-range level of 10% of revenues. After running the simulation with this strategic position, we found many things that went well. As you see from these 3 graphs, with keeping enough employees on board, we lowered our average work week from 46 to 42 hours. By doing this, we had a higher employee retention, which caused our rookie fraction to decrease after our initial bump up because of buying a new plane. By keeping a higher number of employees per plane, we found that it made our customer satisfaction increase. When customer satisfaction increases, then our demand on a rapid increase, which helped our business remain profitable. From the graphs here, we can see how our strategy truly affected our business. Revenues were slowly increasing each year, which covered our cost of buying a new plane at the beginning of each year. Our cash flow dipped in year 2 when we purchased our first aircraft, but then started an upward trend, keeping in line with our revenues. Because we were able to keep costs low, we had positive net income every year. With our company gaining profitability, it sent our stock price skyrocketing to over $50 per share by the end of year 5.
Hi, I'm Chris. I'm going to talk to you about scenario 2, high fares, high satisfaction. Our goal for this strategy was to steadily increase fares while maintaining extremely high customer satisfaction. Please look at the employee retention and rookie fraction graphs. One of the goals for this strategy was to keep employee experience high and in return keep customer satisfaction high. Therefore, we initially hired a surplus of employees to keep the number of employees per plane between 58 and 60. When looking at the graph, you will notice the rookie fraction has 2 spikes in the first 1.5 to 2 years when the 4th, 5th, and 6th planes were purchased. After that point, we hired enough employees to match turnover and drive the rookie fraction below 0.1. For years 2 to 5, therefore, the employee experience went up as displayed in the steadily high employee retention after year 2. Looking at the customer service graph, one key point in this strategy was to keep customer service above 1.0 so we could steadily increase fares while maintaining happy customers. If you look at the graph, we start with customer service of 1.0, then briefly drop to the upper 90s, 0.90s between year 1, quarter 1, and year 2, quarter 1, while we figured out the proper number of employees per plane. Once we decided on 58 employees per plane, customer satisfaction jumped to 1.05, then steadily climbs through year 5, quarter 4 to 1.20. With a service scope of 0.7 the entire time, maintaining high customer satisfaction, we were able to successfully increase fares without our load factor being negatively impacted. Please look at the growth rates graph and focus on the green line, which represents capacity. For this strategy, we aim to keep our load factor at 0.4 and above. We only acquire 3 additional planes of a total of 6. Therefore, it is key to keep our load factor at a minimum of 0.4 in order to generate sizable profits. As the graph depicts, we start at 0.57 in year 1, quarter 1. We had 1 additional plane in year 1, quarter 2, which brings down our load factor to 0.44, then jumps to 0.48, 0.49, and 0.50 in the next progressive quarters until we purchase 2 more planes for a total of 6 in year 2, quarter 2, dropping our load factor to 0.33. At that point, we aimed on increasing load factor rather than capacity, and successfully increased load factor steadily each quarter until year 5, quarter 4, when our load factor reaches 0.43. Next, we're going to discuss strategy number 3.
Hi, I'm Tarek, and I'm going to talk about scenario 3, which is lose to win. This scenario is the one with the highest income of $2.9 billion. The strategy we used is almost the opposite of the Domber's case. We started slow at the beginning. We bought aircrafts only when we needed them. Our people's fare was 9 cents and going up slowly. We went above the average competitor at the last year only. We kept employees per plane at 55 employees. Marketing was average at the beginning. At the end, we decided to lose the whole marketing and kept it at 0. As you can see, the net income, we started out with a net loss, and then we went up to net income in the second year. The maximum net loss was $27 million. And these 2 years that we started with the net loss were the reason for our success in the future years. As you can see, the aircrafts we purchased were very slow, and we didn't purchase aircrafts when we didn't need them. For the employee retention and the rookie fraction, at the beginning we had a high rookie fraction because we were new in the market, and after we gained enough experience, our rookie fraction decreased. For the market share and the stock price, we gained market share each time we kept gaining net income, and we were doing better each quarter, and the market share was going up. And each time the market share went up, we got more stock price.
Next, we'll look at how we decided to choose our best case scenario. We just decided to look at the net income of every scenario and clearly suggest that the lose to win scenario is the best. Not only did we accumulate $2.9 billion, but there were also other notable factors into our choice. We invested in our employees to have a strong infrastructure. Towards the end of the simulation, we built up customer following. So we cut marketing the last year. We bought aircraft when needed, increased our market share and customer service, and finally ended with a more than double break-even load factor. Next is our system dynamics model, and it shows how we came up with our best scenario. Many factors go into building an airline empire. To make it simpler, we broke it down in expenses and revenues. First, we will look at aircraft purchases. In the beginning, aircraft purchases were low, and at the start of year 2 began to increase to 6 aircraft purchases every quarter until the end of year 5, ending with 85 total aircraft. Next, our employee hirings kept increasing heavily to 4,645 total employees and only losing 156 per quarter. Last, we'll look at marketing costs. This began to increase until year 4 and then dropped considerably at the end when we built up a following of customers. Next, we'll look at our revenues. In this section, we started out with a low customer fare in order to build up customer service. And towards the end, beginning at year 4, we increased our revenues beyond our competitors at 17. This accumulated to our net income of $2.9 billion. And this is our systems dynamics model and our People Express simulation project.